Hello and welcome to yet another instalment of our Nucleus Wealth Insight series. Just a quick reminder that the following presentation is general information only and does not take into account your personal circumstances. Whilst Nucleus Wealth aims to present informing and sometimes entertaining content, please consult your investment professional, financial advisor, or better yet, speak to us before making any decisions based on any themes discussed in today's presentation. Our presenters today include myself, Tim Fuller, a certified financial advisor who has worked with hundreds of clients over the years, helping to make the complex simple for companies such as AMP, Mercer, and independent advisories. We also have sitting across from me David Llewellyn-Smith, co-author of The Great Crash of 2008 with Ross Garnaut, founder of the internationally acclaimed Diplomat magazine, and now chief editor of the enormously popular Macro Business financial blog. And sitting next to him, of course, we have Nucleus Wealth's Head of Investments, Damien Klassen, whose 25 years in the world of finance has seen him as the founding partner and head of research for analyst firm Aegis Equities, head of quantitative strategy at Wilson HTM, and was responsible for mining, energy, and big data in the $60 billion global quantitative equity fund at Schroders, which are a multinational asset management company. And for more information, please see our people section at www.nucleuswealth.com. Just a quick reminder too to all those that are listening in that this is a live presentation. So if you'd like, take full advantage of the chat box to drop any questions in, and we'll answer those along the way. And if you're listening to this recorded, feel free to come along to our next live one if you'd like to participate in a live Q&A. So here we are. We're into 2018 with our second webinar. We're looking at rates of interest, a global review. Obviously, there's been a massive shift, you could say, in the last sort of few decades, and we'll be covering that in depth today regarding where interest rates have gone and certainly the way central banks have had a big role to play in that. By way of agenda, we are looking initially at the thought of lower for longer, and is actually going to be the ongoing fact for life? And secondly, we're then looking into global inflation rates across all the major developed economies as well. And finally, finishing up with reflecting on Australia, of course, and our outlook going forward for global and also local interest rates. So I'll kick off with our global inflation rate question of the day is lower for longer, and I'll hand over to David. Your thoughts, mate?
Thanks, Tim. So this question and answer comes in two parts. The first one is we'll have a look at the structure of inflation globally, and the second one is looking at the inflationary cycle because we're quite late in the global business cycle. And we'll see how those two are coming together, whether the structural deflations we've seen for a long time are going to win out against the cyclical inflations that we're seeing at the moment. So that first chart there you can see is of global inflation rates, captures beautifully what we call the Great Moderation, which was the collapse of inflation rates worldwide over the last 20 years. There's many explanations for that. Central banks like to claim responsibility, but there are many other factors involved.
Sure.
I've listed some of them. Most of them are structural changes in the global economy. So the labour market, globalisation, which allowed for a great deal of outsourcing to cheaper emerging markets from developed economies. And that continues to this day. More recently, we're seeing big trends in automation, and that's a big trend going forward, which has the potential to displace a great deal of lower-end labour, especially across emerging markets. I think the International Labour Organization has a number of about 20 million jobs being lost in Southeast Asia over the next decade alone.
Wow.
The decline of trade unions is obviously a factor as well, because there's less bargaining power on the side of labour across most economies. And then all of these things tie together, of course, in the relationship between emerging markets and developed economies. And how that's played out with the rise of China is that, it's an excess saver and sustains a lot of supply through that and various protection measures, and that in turn delivers, a lot of cheap goods into the global economy. And then finally, more focused on developed markets, increased wealth inequality is leading to demand deficit. So that just means that because of the concentration in wealth in upper classes who spend less proportionally of their dough, it means per capita you're getting less expenditure or less aggregate demand overall. You could add to that demographic headwinds in those developed markets. So our view is that the structure of that for inflation is unchanged and will continue to be quite powerful. And that chart, the global inflation rates chart, captures that pretty well. As you can see, it's just pancaked over the last 20 years and it really doesn't show much sign of changing. So that ensures, in our view, that the global neutral interest rate will remain far below historic norms, no matter what transpires in the cycle.
Sure.
And that is going to likely support higher asset values and multiples than is historically normal in both bonds and equities. So I'll turn now to what's challenging Western. These next four charts capture, some of what's transpired there. Europe has seen a strong domestic demand recovery that's taken markets a little bit, was a little unexpected. Nonetheless, it's still got very low core inflation. It also has very high unemployment, 8.7%, and the spread of inflation, as you can see in the Eurozone, shows you that Germany is pretty hot, or at least warm, but just about everybody else is still struggling. And so that structural problem that they have in the Eurozone with a strong Germany and a weak everybody else.
And a shared currency.
A shared currency that sits on everybody who's not Germany and gives Germany an enormous boost is still playing out and will continue to do so. So, we think that Eurozone inflation will struggle, and so will the ECB to tighten. It's certainly, talking about doing so. It's definitely lifting or winding back QE because its recovery is very solid, but raising interest rates looks like it'll be quite troublesome, not least because it's got all of these peripheral bonds that are yielding. On the long end of the bond curve, places like Portugal, you get lower yield today than you will in the US 10-year. Which is, obviously an absurd risk suppression.
Yep.
And so the moment the ECB tries to come out of that, there could be a huge snapback in those peripheral bonds. So to cut a long story short, for Europe, raising interest rates will be difficult. Japan, even more so, their core inflation is still zero. And, they've got all the usual structural headwinds to it rising. They're doing their best to get it up, and it probably will come up. It's got very low unemployment now.
Yep.
But they're still your classic mercantilist, and they're not going to give up a cheap yen for anything.
Yep.
And so, rising interest rates there is a bit of a myth, frankly. Sorry, I'll just pass you to Damo.
Damien's got something to add there as well.
Yeah, sure. So I might just talk. What does that mean for the portfolio in terms of these ones? So the in terms of Europe, what that means is we're looking very much at the strong euro that we've seen over the last little while, and typically you see it takes 6 to 18 months for the effect of stronger currencies to sort of flow through into to more jobs or less jobs. And so the strength of the euro means that that's sort of weighing on demand within Europe. So we're sort of quite careful as to what we're trying to pick out in terms of the stock side. So trying to avoid some of the big exporters that have prices very much the costs based in euros is the key. So that's not every stock that's listed there. There are a lot of stocks with operations not completely in Europe, so that sort of makes an effect. But if you're looking at people, if you're looking at companies that have European operations with a rising euro, and in our view, the demand's not really there. It's sort of if we're keeping inflation rates low, then we're sort of looking for European growth to be relatively weak, given the sort of where the euro is. On the Japan side, it's a little bit more difficult in that, as David was saying, the Japanese companies, most of the listed ones tend to be exporters, and so it is a matter of trying to offset or trying to work out within the Japanese economy if what you get from stocks appreciating as the yen falls, you actually give up on the currency. And so it is a market where the timing of both where you buy in from a yen perspective and which companies you're getting into is also important.
Okay, and so I guess just touching on the Japanese conundrum there of having to pick a time when you've got currency head or tailwinds potentially on top of stock headwinds and tailwinds. Where do we sit there in terms of the portfolio? Is it sort of are we in a time now where we'd be looking at it, or is it what's the current state of play in the portfolio?
Yeah, look, the weakness in the US dollar is the real thing here. So I guess the question sort of running through our heads is, will that, if we see the US dollar come back to start to rise, which we think sort of it will on balance, then you're seeing that falling yen. So you might be giving up a little bit, but on the flip side, you're gaining on the stocks.
Okay.
So adding then in the Australian dollar, and given our view there is relatively negative on the Australian dollar as well. If we're
Sure.
it's a question of, will the Aussie dollar fall faster than the yen, and so we do think that's probably the case.
Yep.
And so it is a time where we are looking at some of the exporters within Japan.
Okay, fantastic. And on that note, we mentioned there the US dollar, so we might move over to the US inflation graph that we've got there.
And so just carrying on through the big economies. In US inflation, core inflation's also been weak, but is recovering slowly but surely, and is likely to firm, on a steady trend over the next 12 or 18 months. Where there's been a great deal of excitement over the last week is after the jobs report on Friday.
Sure.
There was a big jump in wages growth.
Yep.
Taking it close to 3%, and that has the potential to add a bit of a wage push inflation tailwind to the US. Nonetheless, those other headwinds have been there. The big inflationary pulse in recent times in the US, as Damo said, has been the falling US dollar, and we're of the view that that's actually been a large component in the recent volatility as the US dollar fell and threatened to sort of overheat the US with all of its other tailwinds, and it's driven yields up very fast. And the combination of falling bonds and the falling US dollar has really upset the stock market.
Yep.
Pushing on, moving to China, the major economy, and as you can see, there's been a huge spike in PPI. That's the producer inflation, but it's hardly budged consumer inflation at all. It remains quite weak, very weak for an emerging market. And as you can also see, the producer inflation has started to fall, and there are other indicators already in the market suggesting it's falling quite fast now. Some of the price indicators in the PMIs and what have you. Now, when it comes to inflation in China, what really matters is the PPI, because the CPI is so contained at this point, it's not really going to impact what the PBOC does.
Okay.
But the PPI is a terrific leading indicator on industrial growth.
Yep.
In China. And the fact that it's coming off is telling you what our other indicators are saying, such as, the credit slowdown, etc., is that China is going to slow. It's going to grow fine. We're not saying it's falling off a cliff, but it's definitely going to slow through this year.
Okay.
And that PPI should fall quite fast as it does. Because once it starts to slow, you get all sorts of deflationary loops back into mining, coal, iron ore and steel. And as you can see from the chart, they rise very fast, but they also fall very fast.
It is a dramatic move, isn't it? Moving line there.
It is. So we more or less see that transpiring as it did in kind of 2011-12, where it comes back very sharply. So, that has implications for the global cycle in that it's going to lend, some more deflationary headwind to, at the moment, everyone's very excited about synchronized global growth and the US leading this kind of global uptick in growth. We think by mid-year, China is going to be sort of raining on this parade. And so that's important when we come to look at how these various inflation rates come together in terms of central bank action and what that's going to do to interest rates.
Yep.
So I'll just wrap that all up into the outlook.
Okay, yep.
There.
Oh, sorry, Damien just had a couple of things on.
Oh, Damien's going to add a few things.
Damien's got a couple of things on the US and China. So we're sharing a microphone here, ladies and gentlemen. So just bear with us.
Yeah, look, the things I'd like to just want to highlight there. So we've obviously run through a structural case where we think that inflation is low. The other side of the argument, if you took the view that inflation is just about to take off, there's sort of a couple of different reasons you can put into that. First of all, is the what you call the China excess capacity argument, in terms of saying China's been chasing growth at any cost over the last sort of 10 to 15 years, and that has that's what that meant is a great deal of excess capacity within China, which then exports deflation to the rest of the world. And so the argument is as China, as growth stops being as much of a focus in China, that then that excess capacity goes away, and that then China starts to export inflation back to the rest of the world. Now, look, there may be there's certainly some element of truth in this argument, and the question is whether it's at the margin or whether it's big enough to offset the other factors in terms of the lack of demand and things like that. Our take is that the excess capacity isn't going away anytime soon. You do need to actually see growth actually slow in China, so we're only just seeing the start of that, and to think that they've got all this excess capacity, they're still growing quite strongly. That growth's going to taper off, but all of a sudden that's going to start exporting inflation to the rest of the world. We think that even if this story is true, there's sort of a 5-10 year lag you're going to be looking at before you actually get to that point.
That long? Wow.
Yeah, just because there is so much sort of excess capacity, and we're not talking about, unless you see growth dramatically slow in China, and then you might sort of see that.
Okay.
And the question is, will other people take over as well? And there's lots of other things that could play out on that front. The second one is that that inflation sort of lying in wait in the US. There's this latent inflation that sort of pressures that are all building up, and at a certain stage, unemployment hits a particular level, and then all of a sudden, this inflation is going to come booming back into the sector, back into the economy. Our take on this one, this is a hard one to refute, because it's a very sort of airy sort of argument, is sort of suggesting that inflation's always lying in wait, and you've just got to check under your bed and it'll jump out. Which might have been true in the 70s
in the
and
past.
80s.
Yeah.
We think that we have hit a moderation. We think there are some structural issues that mean that's not going to be the case. Having said that, there are the thing that can get inflation going is debt. Big increases in debt, and but we think that's pretty limited, and that's what we are expecting to see. This Trump stimulus and the tax cuts actually mean that the US increases debt quite dramatically. China's probably slowing at the offset a little bit of that, but we are going to see this great big debt push, which means we'll see some inflation coming through, but we expect that to be transient inflation. So we're sort of working on our portfolio. We're sort of looking at how can we trade that and make sure we're not caught too far on the wrong side of that, but acknowledging we think it is going to be transient inflation. So if markets start to price in, this inflation is going on forever, that's where we'll start trying to see where we can take advantage of that in our portfolios.
Okay.
We had a long look at inflation-linked bonds for that reason. So inflation-linked bonds are inflation-linked government bonds are bonds which pay you more money the higher the inflation is, and more so than that, it's the higher the expectation. Oh, sorry, they pay based on the sorry, let me start that one.
So it's a coupon plus inflation sort of.
Exactly.
Yeah.
So you get that. What they're priced on is they're priced on expectation of inflation. So expectations have been very low. So that's roughly sits with ours. So we're just trying to work at, is there a change in that expectation that sort of flows through? The issue for us is that with a falling Australian dollar and looking at these in Australian dollar terms, with a falling Australian dollar, and we expect that inflation might tick up in the US, and inflation expectations might pick up in the US. We don't think that the same effect's going to happen in Australia. So we sort of had a very long look at this, and sort of in the end opted not to sort of switch more of our bonds into that sort of as a sort of medium termish trade as inflation expectations pick up, that there might be some strength in that area. But we think the risk is sort of not worth playing on that front.
And you mentioned there before, obviously a very big driver of demand in general is debt, and Australia's sort of just looking at Australia now. No, we will jump across to Australia in more detail in a moment, but obviously Australia having such a huge ramp in debt in the last, the housing bubble, the 20-year housing bubble, and all the the equity that's been probably gained and spent in the economy. It would be a significant headwind for us on that basis.
Yeah, it just means it makes it difficult. So the problem when you are increasing your debt every year, and that's what out there driving the economy. When even if you just slow that rate down, that actually tends to slow the economy down. So,
and our inflation's struggling as it is.
Yeah,
which is fascinating.
So you do have to look to what level you start to hit the constraints.
Sure. Okay, very good. And just as a cap, we've got just a quick outlook there. So I'll hand over to David just to give us some global broad outlooks there. Where we're going.
So, just sort of formalising what Damo was saying. China to slow, and kind of key commodity prices to fall. I think that will probably be exacerbated by a return to some strength in the US dollar. We don't think Chinese growth will slow enough to cause it to ease monetary policy. Some people are already calling that, but we don't think it's the base case. It will happen if it overshoots to the downside. Japan will grow a little bit, and a little bit of inflation, but no chance of rate hikes. We expect more QE, whatever it takes to keep the yen down. Eurozone recovery to peak by mid-year. ECB to force to wait longer than maybe even it would like for rate rises, especially as it runs QE off. And the Fed probably forced to hike 3 times this year and possibly even 4, although that will depend on where the US dollar goes from here. The further down it goes, the more inflation they're going to see. So turning to Australia.
Oh, got Damien back there.
Sorry to bounce back and forth. It's a good point. David's talking about there is that a lot of this stuff is currency dependent. So from the perspective of an investor looking at these things, we need to take into account that the Fed doesn't operate in a bubble of its own, or in exclusion to others. So if the US dollar does continue to be low, that's going to make the US economy stronger in that they'll be able to export more to other countries, and their imports will be a little bit more expensive, so they'll see a bit more inflation from that, and they'll see more economic growth within the economy. That's going to force the Fed to have to raise rates more, which probably then means that investors with higher interest rates then want to flow back into the US dollar and balance things out. But as David's saying, it's an important measure to look at is that any of these rate hikes can't be looked at just in exclusion and say, yeah, look, there's going to be 4 rate hikes. If the US dollar's lower, there'll be more. If the US dollar bounces back and goes higher, there'll be less.
Okay. Yep. Very good. And David, just finally there on the US Fed, because obviously in comparison to the other three dots there, the Eurozone, Japan and China obviously are looking, I guess, essentially a decade on from a global financial crisis. Fair enough. US originated. There's been, they've tried the the helicopter money, the QE process, and now of course it's looking like they're raising rates. So would you say, I guess, just on that basis that that what they've done has worked? Has it worked as well as it should have? Or I guess your general thoughts there. Yeah.
From a very sort of simple standpoint, yes, it has worked. And I expect it to work again at the end of this cycle.
And that was my next question. Do we just expect this year?
If you're not a political economist,
sure,
and you don't look at some of the fallout in terms of who got richer and poorer and what that's done for the economy, and
yep,
it's definitely made worse wealth inequality, for instance, which means that
absolutely
they've actually baked in more deflation. So in the long term, structurally, it's not worked, but it's definitely worked in the short term to juice markets, juice wealth, get people spending again. And now we've kind of got we're ending the cycle quite oddly with a fiscal burst from Donald Trump, which it doesn't make a whole lot of sense, but it is what it is.
Yep.
Come the end of the cycle, I simply expect them to do what they did last time times 10. I mean, I'm not sort of an Armageddon guy. I don't think that any of these things result in the end of the world. I mean, fiat currency obviously is coming under pressure as these things transpire, but they'll probably do it a bit differently by the end of the cycle with some more QE for Main Street. This is where we start to get into discussions of universal basic incomes or a lot more infrastructure spending funded directly by the central bank. I mean,
personal tax cuts perhaps as well.
Possibly. So, I mean, there's all sorts of monetization that can transpire that trashes the old system in so far as all of your old political economy agendas collapse between fiscal, monetary, government, central bank independence, all those things start to dissolve.
Yep.
But when you've got, everybody in these organisations are can kickers, so they'll do what it takes.
Protect their nest.
I think so.
Okay.
So just to sort of wrap up the inflation and interest rate outlook in general terms, turning to Australia.
Sure.
Core inflation here is weak. We expect it to stay that way. It's firmed a little, but the mix of growth drivers and headwinds is such that it's unlikely to result in much higher core inflation. The headwinds, there's a steepening fall in residential construction underway. We're not sure how steep it is at the moment, but it appears to be getting quite steep at the moment with the withdrawal of Chinese capital. The income crunch for consumers, owing to poor economic structure and immigration and falling house prices, the falling terms of trade, the whole caboodle. Macroprudential tightening, slowing credit. And then a renewed income shock from China in the second half as it starts to slow materially. We've discussed this before in these programs where Chinese inventories on bulk commodities are enormous, and if the cycle reaches a tipping point for steel mills, then they'll destock, and we'll see big falls in iron ore and coking coal, which will take Australia's terms of trade much lower.
Yep.
That is probably the primary risk. That and housing turning unruly, housing price falls, which is not our base case either. We're still sticking with a slow melt, but you never know, is the sort of risks for an unexpected rate cut. Still think that the next move will be down.
Yeah, well, obviously with Phil lower for longer coming out the other day with the hold, everyone I think sort of essentially the world expected that, but at the same time there was there was rumours of tightening at least late last year, I remember, and I guess now, what thoughts going forward given that?
Yeah, well,
Damien.
I'm going to jump in before David.
Yeah, sure.
On David, let him give his thoughts on that. But I just wanted to sort of discuss about how that affects the portfolio as we're putting it together.
Okay.
So ordinarily, you'd say if we think rates are if you think people are on the wrong side of the trade, everyone's looking for rate rises when there's going to be rate falls, and the Australian economy is going to be a lot weaker. Traditionally, you'd be like saying, well, let's jump into bonds and let's get at the long end of the bonds, and we'll actually see a bit of movement there, and pick up a few percent in terms of playing that long end of the bond curve as the expectations change.
Yep.
The issue with doing that is that bonds do trade based on interest expectations in Australia, but they also trade on a relative basis to other markets in the world.
Mm.
And so if we do see the US
Raising
yield,
rates. Yep.
and we see the US long end of the yield curve in the US sort of pick up, we don't expect the Australian long end to pick up anywhere near as fast, but you could see that it rises as well. So Australia might be the laggard in the world in terms of the where we are in the cycle versus others, but you may still see that you don't get the price expectation you might be expecting at the long end of the curve. So we're still we're invested there. It's just we're not as invested as we would be if we thought that the US wasn't going to be.
It was loosening rather than tightening, I guess, essentially.
Yeah, and we thought that the US wasn't headed for some sort of short-term inflation increases there.
Okay.
So so from our portfolio, we're sort of trying to stick with a fair bit of cash, bonds where we can see the
shorter
value,
date. Yep.
shorter date-ish, but a lot of that is based on that equity markets are expensive, and we're just sort of trying to maintain that point of where we can where we can see the trying to walk that tightrope line, having enough exposure to these markets as they melt higher, that if we do see markets pull back, that we're not sort of caught unawares and without sufficient hedges.
Okay. Yep. Fantastic. All right, and back to David just for final thoughts on looking forward. And
I guess just closing, I should probably make reference to the recent volatility that's been driven by indications of very strong US growth in the offing, and that's caused bond yields to sell off more at the long end than it had previously, as the labour market genuinely tightens and Trump pulls in more and more spending, and crucially because the US dollar has been falling. So we've had this accident, as it were, in the short volatility segment of the market, which has been caught unawares by rising inflation expectations. The question now is how far does this boom go? How much does inflation actually rebound? How much has the Fed got to tighten?
Yep.
And where does the US dollar go? And how do all of those things tip into this volatility? So I mean, until recently, what had been transpiring in the US bond market was rising short end yields. So
yes.
That's the 2-year was going up very fast, so people were selling it in anticipation of Fed rate hikes. But the longer end of the curve had been falling. The yields had been falling, and so it's what's called a curve flattening, and that is a typical indicator of falling growth, slowing growth. And if it reaches a point where the curve inverts, as they say, and that is long end rates end up or short end rates end up higher than long end rates,
sure,
then that's a classic signal of a recession. So until recently, that was the trend, and now suddenly everyone's kind of got a hold of this US boom, and they're now concerned, that inflation is going to run a bit higher for longer, and so we've had a curve steepening as the long end rates rise. So how far does it go, and what does that do to the stock market? And the effect of the US dollar falling as well. Yeah, and the US dollar fell. I think that the US dollar is probably bottom, but you can't say for sure. That's based also on the euro. The trade into the euro was very powerful and got very imbalanced, and I think that may have run its course as well. So that's going to help take some of the heat out of the sell-off in the bonds, the US bonds. As well, at some point, people are going to start to see some value at the long end in US bonds because, the Trump boom isn't forever.
Yep.
It is stimulus based, and even though it's got a tight labour market. The Fed probably can snuff it out without going too high. And so at a certain point, I suspect we're going to start to see a curve flattening again, is what that amounts to.
Sure.
Do 10-year yields go above 3%? Probably. Is that going to bring some more volatility to the stock market? Probably.
Yep.
At a certain point, there should be an equilibrium in here somewhere, that the curve flattening enables, a little bit more calm, because this US boom has still got a ways to run.
Yep.
And, the tailwinds behind corporate profits are very strong for the next 12 to 18 months.
Yep.
And so, those who are looking to tap into those in equities, they're still going to be sitting there looking for the opportunities. So, it's the beginning of a shakeout. Hard to know exactly how it transpires, but I think that there will probably be an opportunity for the market to go higher before the Fed actually raises enough that the whole thing comes crashing down, basically.
Yeah, right. Okay. Fascinating. All right. Very good. And I think that might be it. No, or if you've got anything else to add on the back there, Damien, we'll.
No, I've probably preempted that.
Okay.
Preempted most of it. I think the only thing I'd comment just on the on the falls we had earlier in the week and late last week in the US is that it was sort of triggered initially by this as David said, rising long-term rates and the falling US dollar, which is a very weird combination. Usually, when you have rates increasing, that actually attracts capital back, and you don't often find that you get that same combination in developed market economies. Emerging markets, it's usually a sign of risk.
The inverse,
Yeah.
Okay.
So it's not usually something you see, and that sort of drove, I think, that initial downward fall in the market. And look, the market's been incredibly strong over the last sort of year and a bit. So there's obviously scope for it to fall a couple of percent without sort of upsetting too much.
Yep.
The wave downward we saw then again came back down to this volatility trade, the short volatility trade. Now, we've written a bit up of this on the blog, so jump on and have a look at what we've written. I think the key bit there is we do think this is a sort of more of a transient trade, and that a bunch of people sort of got caught in this explicit trade, which seemed like a good idea at the time, and it was one of these sort of classic picking pennies up in front of bulldozers, and the bulldozer came along. And so that sort of washout. There are a lot of other trades that are very similar in structure, but we do think the move would have to be a lot bigger to shake those out.
Yeah,
so
right.
So there's this sort of latent risk in the market that a lot of people have sort of followed a similar strategy to the one that we saw sort of push the market down. But in our view, we would to see a real shakeout in this other part of the market. And now we think the explicit short vol was probably less than 100 mil. The implicit short vol is probably more like $1 trillion or more.
Wow.
So it's big numbers, but they're going to need significant rate rises, a couple of percent of interest rate rises, and probably a very sharp, 5-10%, 10% plus fall in the market before you really see a shakeout in that area. So.
Okay, no worries. All right, very good. Thank you. Thanks very much. So thanks to David and thanks to Damien for your thoughts there. We've just got a phone ringing in the background, but just excuse that. We'll take this time to just move across into a little bit about us. So Nucleus Wealth and the Macro Business Fund was put together to help give you access to quality and well-researched stock analysis, superior macroeconomically minded asset allocation. We do use technology to help us provide a service typically only available to high net worth and sophisticated investors at a fee level that rivals the more basic solutions available to everyday investors. We principally do this through what's called a separately managed account, and that allows clients to enjoy unparalleled transparency of what they own and why. It also means that each client effectively owns their own separate and discrete share portfolio managed by us. We've partnered with Linear Asset Management, you can see there, who's backed by the ANZ Bank for cash management, and JP Morgan, who are one of the biggest banks in the world, as custodian of your assets. We feel this structure is the gold standard for your financial protection. In addition to this, we offer 19 separate and individual ethical screens that you can use to help tailor your investment to ensure that your money is being used to support companies that deal in areas and practices that you feel are important. By eliminating only the areas that are important to you, you keep the potential for higher returning areas that you might otherwise be ambivalent about and would normally be ruled out in broader ethical products currently available on the market. So the name Nucleus Wealth, or Nucleus in Nucleus Wealth, comes from our ability to provide the core holdings of a client's portfolio, allowing them time to explore areas that may be of interest or they may have experience in otherwise. We do also offer the complete investment solution for those who don't have the time to coordinate their own investments. Our investment team has decades of experience in world markets, and we have access to a global team of stock analysts. And also, by removing the layers of middlemen that sit typically between your money and the markets, we've been able to reduce our fees and provide unparalleled transparency in the solutions we provide. So for more information on this, or if you'd like to get in touch, please give us a call on 1300 623 863, or you can check us out at www.nucleuswealth.com. So next week, of course, we've got at the same time, Thursday on the 15th of February at 12:30, we've got our next instalment of Nucleus Insights, which we've called 2018 to 2028, Where to Invest for Australia's Lost Decade. Really looking forward to that. So make sure you head over to proton.nucleuswealth.com and register for your attendance there, and we can send you the link. You can come along and check it out. And of course, keep in mind we've got live Q&A, and I think this one is going to be well attended, and we're going to get plenty of questions as well, so that'll be great. Just finally, of course, as always, our communications expert here, Maddie, will be sending out a survey on how we've gone today, but also to give you a few topics to choose from to help give us some direction on where to do our next webinars and what you'd be interested in. So on that note, I'd thank you very much for your attendance today, and I look forward to joining you on the next one. Cheers.